In this video, we're going to look at how you can calculate and assess fair value based on the future expectations of the growth of any stock you're looking at. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Welcome to part 2 of my 3-part series where I'm talking about how you can calculate and how you can understand intrinsic value and why it's so important to long-term investment success. Calculating fair value based on growth expectations is what this video is about. And in part 1 of this 3-part series, I focus primarily on calculating the intrinsic value of a common stock based on an analysis and review of historical information and data. Although I strongly believe that there is much that investors can learn by studying the past, I even more strongly believe that since we can only invest in the future, that it is also implicit that we embrace a rational method of forecasting. Years ago, I expressed my views on this important issue of developing a reasonable and rational expectation of the future prospect of a business as follows, and I'm quoting myself here. We cannot escape the obligation to forecast. Our results depend on it. Our forecast should not be mere prophecy, and we should not simply guess, nor should we play hunches. Instead, we must endeavor to calculate reasonable probabilities based on all factual information that we can assemble. Analytical methods should then be employed based upon our underlying earnings-driven rationale, providing us reasons to believe that the relationship producing earnings growth will persist in the future. Furthermore, I believe that forecasting future earnings is the key to investment success, based on my belief and understanding of the undeniable fact that earnings and cash flow determine market price and also dividend income in the long run. Not only do I believe that this previous statement is logical, years of observation and personal experience have led me to confidently state that there exists a large volume of historical evidence validating the long-term earnings and price relationship. In short, any business, public or private, derives its value from the amount of cash it can generate on behalf of its stakeholders. Consequently, I will sum up this introduction by stating that analyzing a stock is best done based on careful consideration and analysis of past, present, and most importantly, future deliberations. More simply stated, I believe that we should learn as much as we can from the past, carefully focus on the present, especially on current valuation based on the earnings yield, and finally, we must attempt to make rational and reasonable forecasts of what we can expect in the future. Moreover, it is the future prospects of the business that will be most relevant to us, but it is also the most challenging for us to ascertain. In my first video of this 3-part series, I provided numerous discussion points referencing Ben Graham's thoughts on calculating intrinsic value. Most of my references came from his book, The Intelligent Investor, and a few came from his other work, Security Analysis. But most importantly, I suggested that followers and devotees of Ben Graham should focus more on the underlying principles that made up the foundation of the many timeless lessons that this master offered us, rather than attempting to apply rigid or absolute adherence. This especially relates to the utilization of any of his mathematical formulas. Ben Graham provided useful mathematical equations that can assist us in calculating a reasonable valuation based on certain types of investments. However, the answers produced by his equations should only be thought of as a guide or reference to fair value, at least in my humble opinion. In other words, the precise number is not anywhere near as important as the determination of a reasonable fair value calculation within a reasonable range. It's never perfectly precise. In other words, although I feel I learned a great deal from Ben Graham, I also believe that he never intended anyone to be too zealous with his teachings. I believe an excellent example of overzealousness can be found on the following commentary from the revised edition of The Intelligent Investor presented by Jason Zweig. On page 374, commentary on chapter 14, Moderate PE Ratio is the title. Graham recommends limiting yourself to stocks whose current price is no more than 15 times average earnings over the past 3 years. Incredibly, the prevailing practice on Wall Street today is to value stocks by dividing their current price by something called next year's earnings, Jason said. That gives what is sometimes called the forward PE ratio, but it's nonsensical to derive a price-earnings ratio by dividing the known current price by an unknown future earnings. Now, with the commentary, I would argue that Jason Zweig is rigidly inferring that Ben Graham made his intrinsic value calculations solely on history. However, I disagree with his assessment, and even more so with the implications that I feel he actually so disrespectfully expressed regarding his views on the prevailing practice of utilizing the forward PE ratio. I especially object to the use of the word nonsensical. First and foremost, I surmise two things that I believe Ben Graham was trying to accomplish by suggesting that calculating intrinsic value be based on historical information. Number one, I believe that Ben was utilizing only the best information available to him at the time, which I might add was prior to the enormous amount of financial data, information, and technology available to investors in today's more modern world with the internet and so on. However, with my second hypothesis, I suggest that Ben Graham was utilizing historical information as a basis of a forecast of sorts regarding what he believed the future prospects of the stocks he was considering might be. Stated more simply, I don't believe that Ben Graham was trying to identify businesses that he felt would be awful in the future. Instead, I believe he was using history to help him identify companies that he believed had good prospects for an enduring future success. Moreover, I believe that Ben Graham believed in basing his decisions on comprehensive research to identify quality, undervalued businesses that he could invest in. Implicit in this, at least in my humble opinion, is a view of a bright future for any company he was desirous of investing in. Jason Zweig then went on to add a discussion where he referenced a commonly cited study conducted by David Dreman and Michael Berry on the accuracy of analyst estimates. In my mind, the implication of this next comment by Jason Zweig was not only designed to discredit the relevance of analyst estimates, it was also implying that basing investment decisions on a forecast of the future was, as he put it, nonsensical. Frankly, as I already indicated, I could not disagree more, and I will elaborate more on my reasons why later. Over the long run, David said, money manager David Brenham has shown 59% of Wall Street consensus earnings forecasts missed the mark by a mortifyingly wide margin, either underestimating or overestimating the actual reported earnings by at least 15%. Moreover, Jason Zweig also failed to share some additional, and I believe extremely important perspectives that David Dreman also presented in his study regarding analyst estimates. The following quote comes from a paper authored by David Dreman titled Exploiting Behavioral Finance, Portfolio Strategy and Construction, where he eloquently pointed out the challenges of estimating future faced by analysts. To the analyst's credit, David said, they face a difficult environment with thousands of inputs. Many decisions must be made about how to quantify a company's earnings estimates. A company may operate in as many as 50 to 100 different countries and have dozens of different products. Company managers, in doing their job properly, do not add to the precision. The analyst's job is difficult, and expecting them to estimate earnings on the nail every time is simply not realistic. My next David Dreman quote provides further corroboration that he recognized the difficulty that analysts face when attempting to estimate a company's future earnings especially. However, my main purpose in offering this quote is to focus on the last sentence, which I believe offers sound counsel. I will also elaborate more fully on this important subject later in this video. David said, most current security analysis requires a precision in analyst estimates that is impossible to provide. Avoid methods that demand this level of accuracy, David said. But perhaps the most interesting David Dreman quote that applies to the context of Jason Zweig's comments is this next one. It appears that David Dreman was also not too fond of basing investment decisions solely on the past. It is impossible, David said, in a dynamic economy with constantly changing political, economic, industrial, and competitive conditions to use the past to estimate the future. David Dreman. Forecasting earnings is the key, and analyst estimates provide a valuable insight in what the future prospects of the company might be, in my opinion. Analysts are trained professionals that cover the company and its industry that the forecast of the future is made upon. However, contrary to the study that Jason Zweig referenced earlier, I believe in evaluating the specific analyst estimates on each specific company rather than a generalized study, therefore covering all analysts. This is why we developed the analyst scorecard on FastGraphs. With this tool, we can evaluate how accurate analysts have been in the past for each individual company we are researching within reasonable margins of error. Furthermore, as I posted earlier in this video, I believe it is implicit to forecast future earnings as reliably and accurately as we can to make successful investments in common stocks. However, I admit this is a daunting task for most investors, whether you're a professional or a layperson. But since I believe it must be done, again, with a reasonable enough range of accuracy to be useful, I also believe that it is a task that cannot be skipped over or avoided. As I stated earlier, our future success depends upon it. Moreover, at this point, I would like to add that the real meaning of forecasting future earnings is so we can determine what the size and amount of the future cash flows that a stock under our consideration might be capable of generating for us. This is extremely important because assessing the net present value of our expected future income stream is at the heart of determining fair value, or what many call intrinsic value. Calculating net present value is functionally related to today's wide utilization of discounted cash flow analysis as a stock selection tool. This is precisely what the FastGraphs Fundamentals Analyzer software tool is programmed to provide. I'll elaborate more on this important metric in part 3 of this video series. Consequently, once again, we are faced with the challenge of utilizing complex mathematical formulas like these to accomplish our net present value calculations. Although the actual formulas appear complex and even imposing, thanks to the availability of computers and financial calculators, their implementation is actually rather easy to accomplish. However, the determination of the precise factors that must be plugged into the formulas for them to be of value is the greater challenge. The two most important critical factors that need to be input are the determination of your expected velocity of the future cash flows, earnings growth rates in other words, and the correct discount rate to use. Again, I'll elaborate more on these two critical inputs in part 3 of this series. But here is the basic formula for discounting cash flow. And here's also the basic net present value formula. Now, fortunately, as I previously stated, the FastGraph Research tool has been programmed to automatically apply these complex formulas, thereby saving our subscribers the task of calculating them. However, fancy mathematical formulas and models aside, it's important to realize the ultimate goals that we are attempting to accomplish with our forecasts and the associated calculations that are required. Simply stated, we are first trying to determine what the business or the stock is worth today, i.e. its current intrinsic value. Then we're trying to determine what its future potential might be, long-term growth. Finally, we would like to have some sense about what those future dollars might be worth adjusted for inflation or the time value of money. But here I would add that the most important aspects of these goals are the recognition that these calculations cannot be made with laser-like precision. Instead, the best we can hope to accomplish is the determination of a reasonable range of probabilities and possibilities that we can use to make reasonably sound investment decisions upon. As I often say, investing is not a game of perfect. On the other hand, I also like to point out that it doesn't need to be. As Warren Buffett once so aptly put it, it is better to be approximately right than precisely wrong. Later, I'll illustrate how I forecast future earnings and future value with the estimated earnings and return calculator in the FastGraph tool. This is the tool that I personally developed for this specific reason. What follows next is the methodology and approach that I utilize to determine what growth rate that I am comfortable utilizing with the discounted cash flow and net present value formulas. Since I consider these calculations the key to my long-term investing success in common stocks, I place a great deal of importance on trying to be both logical and rational with my forecast for growth. However, and I cannot stress the importance of this enough, I am always approaching this process with the idea of a reasonable range of possibilities firmly in my mind. In other words, I am not so naive as to believe that I can make these calculations on the nail every time, as David Dreaman so aptly said in regarding the challenges that analysts face when making their estimates. Instead, and like Warren Buffett pointed out, my goal is to be generally correct so that I will not be precisely wrong. With these thoughts in mind, I always run what I call a conservative, a moderate, and finally, best case scenarios when making my estimated earnings calculations. Again, I'm trying to be reasonable, not precise. And as I usually do, I will turn to the Fast Graph Fundamentals Analyzer software tool and the Estimated Earnings and Return Calculator to make this task of estimating future earnings simpler and more efficient. Importantly, not all the calculator's estimate data is based on analyst estimates, however. Moreover, I like to think it's appropriate to point out, as I often do, that this is a tool to think with. Therefore, what follows is how I think about earnings estimates when utilizing the calculator. First of all, 3 of the 5 estimated earnings and return calculators are programmed to default to the consensus analyst estimates gathered by and provided by FactSet, our data provider. However, considering the marks I cited regarding the accuracy of analyst estimates, perhaps a few clarifying comments are in order about the value and the utility of considering analyst estimates. Additionally, it is true that several studies have indicated that consensus estimates are inaccurate and sometimes, but not all the time, by a wide margin. However, common sense would also dictate that it would be naive to think otherwise. Moreover, there are a couple of other points about analyst estimates that are often overlooked with these studies. First of all, about half the time the estimates are spot on. As to the times when they are inaccurate, they are still accurate enough to base reasonable decisions upon. This is where the analyst scorecard that we develop comes into play. Subscribers to FastGraphs can evaluate just how accurate analysts have been within reasonable margins of error on the very specific company that's being examined. I'll elaborate on this when I get into the FastGraph tool. Nevertheless, I would never advocate quote-unquote blindly relying upon them. Moreover, when I use them personally, I never see a precise number, as I mentioned before. Instead, my mind immediately goes to an estimated forecast range. In other words, if I see a consensus estimate of 9% growth for the next 5 years, I immediately translate that in my mind into something like 8 to 12%. What's most important to me is whether the numbers are precisely accurate, but whether or not the general direction, and to a lesser extent, the velocity of that direction that I'm concerned with. In other words, how fast will they grow? More simply stated, I ask myself if I believe the company is capable of generating average earnings growth, above average future growth, below average future growth, or worse yet, no growth. Furthermore, I will soon also illustrate that closer estimates tend to be more reliable than estimates that are made farther out in the future. The reason that consensus estimates are programmed into FastGraph Research Tool is to provide us a starting point and or a screening function, but they should never, as I said before, be considered the final say. Furthermore, since the Research Tool updates its data daily, our subscribers are notified as promptly as possible if the estimates are changing either upward or downward. This provides an additional due diligence capability and monitoring function that can be used to keep current tabs on your holdings. First and foremost, the viewer should understand that the calculator provides 3 estimates on each graph based on analysts, 2 that are near term and 1 that is further out. The closest estimate, and therefore the one I consider most reliable, is the actual dollar per share estimate for the current fiscal year. So let's go ahead and turn to FastGraphs and evaluate how you can use the forecasting calculators to make these reasonable and practical long-term views of what the future of the company might be. The first graph we're going to look at here is global payments. Now I'm going to take the prices off this stock for a moment because what I want you to see here that the earnings per share growth has been very strong at almost 17% a year. Therefore, we're using the PE equals growth rate because this is a fast-growing company. And that historical growth rate is relevant to what I'm going to be covering here. But this orange line represents a PE ratio of 16.92, or a PE that's equal to the growth rate. When I put weekly closing prices on, you can see how they relate to that PE very nicely. And then when they got disconnected and got real high here, even though that lasted for several years, it eventually led to this now undervaluation, even though the company's earnings growth has really not faltered much. In fact, you can see that the stock price fell when earnings growth was still strong. The bottom line is that what's the future of this company going to be like? So now we're going to turn to the forecasting calculators. The first one we're going to use is the estimate calculator. The estimate calculator, in this case, there are 35 analysts forecast last year, 35 going forward for the next 2 years, and then it drops off to 14. This is another reason why I suggest that the closer the estimate is, the more accurate it's liable to be. In fact, you even have a bigger consensus for these next 2 years than you do out here for the third year. All right, but just keep that in mind. But now the analyst's average number of these estimates going forward is 12.81%. That relates to the 16.92. It's double digit, and we'll call it conservative. Okay, the normal multiple simply uses a different valuation, but it's the same exact estimate data. The long-term growth estimate is also estimate data, but I want you to note there are only 4 analysts that are giving a long-term growth rate, but they are estimating double-digit growth. Now, that's less than 17, or 16.9, and it's even less than what this current estimate currently is. But the point I want to make is it's still double-digit growth, and these estimates all relate. All right, now the key is, what does the analyst scorecard say? Now, the analyst scorecard on this company, I mean, how accurate analysts have been when they've been forecasting 2 years out on global payments, how accurate have they been historically? And with a 10% margin for error on the 1 year, when they were making a forecast 1 year in advance, they actually had almost an impeccable record. They only missed it 9% of the time. They also beat it 9% of the time. But their 2-year forward estimate with a higher margin of safety, the further the estimate is out, the more likely it is to be inaccurate. They had a 100% hit within that margin of error. Okay, they didn't have some misses, but they were within that margin of error. Again, as I said earlier in the video, you cannot be too precise with these things. Now, the next thing I want to point out is that long-term growth and historic growth, which long-term growth is still analyst estimates, historic growth is actually what happened historically. And this kind of relates more to what I talked about in part 1. But the point is, it's been double digit. So these estimates, based on the analyst scorecard and the fact that they're consistent with the growth, look like they're very reliable for global payments. Now, the next company, I wanted to go to a much slower growing company, only a 4% grower, American Electric Power. But you can see it's been very consistent, and you can see that the stock price, again, relates to that, in this case, 15 PE ratio. There's a very high correlation. When it got high, you could see that the company's performance was rather weak. Valuation matters, and they're always saying it matters a lot. But again, these were not optimum times to invest in this company. These were good times to invest in the company. This was optimum times to invest in the company, because here you can take a 4% grower that's currently fairly valued today and turn it into an 8.5% return investment by buying it when it was inexpensive. Now, when I go into the forecasting calculators, I see 6.51%, a little higher than the history has been. But let's also visit that. If I go back here and run like a 7-year graph, I get pretty close to the 6%. Now, that's not 7 years of history. That's only about 5 years or a little over 4 years of history, because I'm including estimate data. Now, I could take this and take that estimate data out and then run this as a 5-year graph. And now I get 5.86%. And then when I go into the forecasting calculator here and go to the forecasting, I'm looking at 6.5% growth rate expectation, relatively consistent with what's going on. When I look at the historic growth, okay, the 5-year growth is at 5.86%. I just showed you a moment ago. It's consistent with the historical growth, and it's also pretty consistent, not perfectly aligned, but within the same reasonable range. 5, 6, 7% is what analysts are expecting this company to do, and that also aligns with what they've been able to achieve historically over the last 5 years, and that's pretty consistent with what they've achieved. Now, the beauty of it is when you look at their scorecard, it's literally perfect. They 100% of the time hit the estimates with a 10% margin of error that were made 1 year in advance, and they 100% of the time hit the estimates when they made it 2 years in advance. And by the way, I can also go into the custom calculator, and this is in line with my best case, worst case, moderate case, and I can put in, for example, I could say, what if they only grew by 2%? Okay, and then I could draw the graph, and now I've got a 2% growth rate. And if it went to a 15 PE ratio, actually it'd be down to a 12.5 there, but if it stayed at a 15 PE ratio, I'd make 5.76%. That's less than I would be expected to make here if the analyst estimates are correct, which was an 11%. So there's lots of estimate capability here where you can come up with some reasonable forecasts of what the future might actually look like on any company you're examining in fast graphs. Moving on, Ameriprise is another double-digit grower, not quite as fast as we saw with Global Payments. If I shorten the time frame, again, the most recent growth has been about 14%. Shortening and raising the time frames also gives you great insight into how consistent the company has. When I go to forecasting, they're still forecasting double-digit rates, slightly lower than historical growth, but still pretty good. The long-term growth rate is expected to be higher, though, at 17.6. And again, if I look at historical growth, it's been about 15. All these numbers are consistent, and Ameriprise has a very good scorecard. I'd call this one a B+, not necessarily an A, on the 1 year because they did miss estimates. Analysts did 17% of the time, even with the margin of error. But the longer term estimate with a 20% with a higher margin for error only missed 8% of the time. So although I wouldn't say I'm 100% confident in these estimates, I have pretty high confidence that these estimates might be within that reasonable range that I'm looking for. And that's also why we draw orange lines above and below here, because we're always thinking in a range. We use a line as a baseline, and this is the 15 PE ratio that I talked about that Ben Graham likes so much in both of these videos. And that gives you kind of a margin of safety baseline fair value estimate that really will allow you to fully participate in the growth of the company if you buy the stock when it's trading at a 15 PE ratio. And of course, if you buy it at a lower PE ratio, you could expect a higher rate of return. Now, Davita, if you noticed, companies like Ameriprise have this green shaded area, which is the dividend, and this white line, which is also the dividend. And this area below the white line is a payout ratio. But in the case of Davita here, there's no dividend lines on this graph because the company pays no dividend. But it's been a 12.5% grower with moderate cyclicality, especially more recently. But I want you to notice how earnings flattened here and valuation got real high. And when valuation was high like that, you went to an extended period of time of negative results because valuation matters, as I always say, and it matters a great deal. Now, looking at the forecasting for Davita, their analysts are expecting, and there's only 7, this is a smaller company, 11 billion in market cap, analysts expect 14% growth. The long-term growth rate, they expect to be 12. Again, those numbers are consistent, not exact, but consistent. And then if I look at historical growth, as we already did, it's about 18%. It's all double digit. When I go to the scorecard, it's again about a B or a B plus because they have missed estimates 17% of the time on the 1 year, 10% margin of error, and 17% on the 2 year with a 20% margin of error. But I have a pretty good comfort that these estimates give me this idea of being reasonably correct rather than precisely wrong. Or totally wrong, as Warren Buffett, so aptly put it. Now, moving on to AAA rated Johnson & Johnson, consistent grower, been 6.5%. I go to my forecasting calculators. It's expected to grow at about 5%, just under it. That's in line with his history. Long-term growth, about the same at about 4%. But again, their historical growth for the last 5 years has been about 4%. Their longer-term historical growth has been close to that 5 or 6%. So we could even call this a reasonable, if not conservative, growth rate that analysts are expecting. And the point that I want to make is this company has almost a perfect analyst scorecard. So once again, it proves that it's a pretty easy company to forecast. Analysts tend to get this one right. The company probably also gives good guidance when you see those kind of scorecards because not all companies give you great scorecards. If I move on here to United States Steel, I want you to note that earnings of this company are all over the place. Short periods of time, they grow fast. They have periods where they go explosively. Then they have periods where they have no earnings. Totally inconsistent here. When I'm looking at the forecasting graph, analysts are expecting negative growth for the next couple of years. Their long-term growth even worse at 13%. Historical growth has been negative as well. And there's no surprise then that the analyst scorecard is rather abysmal. They beat it or miss it almost all the time. In other words, their misses were 42% on the 1 year and 50% on the 2 year. And my point is, this is not the kind of company I'd want to invest in. I don't want to invest in that kind of history. I don't have any confidence that these estimates are correct, but I really don't care because I really wouldn't want to be investing in a company like that in the first place. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. In summary and conclusion, when Warren Buffett was once asked if he was a value investor or a growth investor, his response went something like this: I am neither and both. I would never invest in a business that I didn't believe could grow, nor would I ever pay more for it than I thought it was worth. My point with sharing this is that I believe intelligent investing requires reasonable estimates of the future, the growth potential of the company in terms of earnings or any other metric that you're considering investing in. On the other hand, with the thousands of companies available to invest in, investors must have a reasonable starting point at their disposal. It would simply be impossible and even impractical to spend the thousands of hours of research required to develop our own estimates on each and every company. Therefore, I believe that having access to analyst estimates do provide us a valuable starting point. Moreover, I also believe that we should do our best to validate estimates provided by analysts before we lay our money down. In other words, there is no shortcut for comprehensive research and due diligence. The bottom line is we must have some place to start, and reviewing estimates by those whose job it is to analyze companies seems like a rather logical starting point to me. In part 3, I will elaborate on ascertaining the most reasonable discount rates to input into our discount cash flow formulas. Anyway, thanks for watching. If you like this video, give me a like, ring the bell, subscribe to the channel, and also take a look at FastGraphs. What a superb tool, and it can help you be a smarter investor. As I like to say, FastGraphs are the value investor's best friend. Thanks for watching.